Hi all, welcome to the CA classroom. Today let us look at the standard AS10 Property, Plant and Equipment. A small background for this. Before we have two standards, AS10 Fixed Assets and AS6 Depreciation. Both these standards were cancelled and a new standard was issued called AS10 Property, Plant and Equipment. The standard is big because both the concepts of fixed assets and depreciation is combined into one standard. Now, why is it called property, plant and equipment? Why is the name changed from fixed assets to PPE? Very simple. Globally, all the countries which follows Ind AS, which is known as IFRS, that started using the denotation property, plant and equipment. So for comparable basis, in India also we started calling it property, plant and equipment. So what are the major areas we will be seeing in this standard? In depreciation, we will just see what are the types of methods to provide depreciation. Your straight line method, diminishing balance method, etc. What to do, how to account if you change the method of your depreciation, and how to decide what is the useful life residual value. Just a few important concepts. In property, plant and equipment, we will majorly see what is the definition of property, plant and equipment, what to include and what to exclude for capitalization purpose, and the standard has specifically given some list of items what to include and what to exclude. We will see those. Then we will also see few important areas where sums are being tested. Now, let us proceed to the definition of property, plant and equipment as per the standard. In the previous section, we have understood background to AS10. Now let us quickly get into understanding definition of a property, plant and equipment. The definition is fairly simple. The first point is property, plant and equipment is used in production or supply of goods or services. Let's say there is a manufacturing company and they have a plant and machinery which is used in production of goods. Let us take another CA office, a chartered accountant's office, where his laptop or desktop is used for supply of services. So laptop is a property, plant and equipment for the chartered accountant. Now, second, property, plant and equipment is used for rental to others. I have a house property. This house I have given to somebody else just to earn rental income. So this house is generating income for me. So this house will be shown as a property, plant and equipment in my books of accounts. For administrative purposes, used for admin purposes, all the fan, light, board, all these furniture and fittings which are used for admin purposes for office, that is a property, plant and equipment. Additionally, in certain factories, it is mandatory to include some safety equipment and environment equipment. You might have seen that because of pollution, they will fix some equipment before the air goes out, it will filter the air, or before the chemicals are sent out, it will filter the chemicals. Now, these equipments do not generate any economic benefits for the company, but however, it is also a property, plant and equipment, because if you don't have this equipment, you cannot operate and you will not have a license to operate. So it is also a property, plant and equipment. Now any of these should be held for more than one period, more than one financial period to be categorized as a property, plant and equipment, and it should not be held for sale. The minute you buy an asset, let's say a chartered accountant is buying a laptop with the intention of selling it, then it becomes inventory, not property, plant and equipment. This is definition to understand what is a property, plant and equipment. The standard also excludes two specific assets, biological assets and wasteful assets. What do do you mean by biological assets? All your living animals, plants, etc. All these are excluded from the standard. However, within biological assets, there is an exclusion called bearer plants. Bearer plants. Bearer plants is covered under your property, plant and equipment. What do you mean by bearer plants? There is a definition for this. Now, let me give you a small example to understand bearer plants. You might have seen in tea estates in Ooty or Kodaikanal, where the ground is sloping. It is a very slopy area and tea plants are very small. So, whenever there is a landslide, there is a risk that for all these plants to come out of the plantation. So, they plant some long trees. You see those tall trees in the tea estate, which is there to hold the ground in a very strong manner so that the soil is strong. Now, these plants are known as bearer plants. Bearer plants do not have any agricultural produce. Produce here is only the tea produce. There is no produce from bearer plants. And after few years, 5-6 years, after the life of the bearer plants, they will be sold as scrap and you will realize some small amount. That is the logic of bearer plants. Now, standard also excludes wasteful assets. What are wasteful assets? All your mineral ores, your coal mining, extracting of oil, all those assets are not covered in PPE because we have a separate standard to deal with this. This is the overview definition of a property, plant and equipment. Now let us move into see what is a cost. When I buy a property, plant, equipment, what will I recognize as cost, what all to include and what all to exclude. In the previous section, we had discussed what is the definition of a property, plant and equipment. Now, how do you measure a property, plant and equipment? What will be the cost of it? Standard has given a guidance. First, whenever you purchase an asset, you pay money to the vendor, the main purchase price, cost. Let's say you are purchasing an AC, the MRP of the AC. That will be included, addition along with the taxes. Exclude those taxes which are refundable, include those taxes where you don't get any credit. Now, second point is cost to bring the asset to its present location and condition. Now, in big factories, they might buy an asset, but they cannot use it until it is installed. So, the cost you incur until it is ready for use. Let us take a small example to understand this. Let's say you have a room in your house and there is no provision to fit a window AC. So, you need to make a small hole in the wall to fix the AC. So, you call the AC company. They said we will install after having some additional charges. So, they will send some person who will come do the installation in your house. So, you have to pay him some direct labor cost. Next, before fitting the AC, he has to make the wall space ready according to the measurements. So, cost of site preparation, preparing the site to install the asset. Another example for cost of site preparation. Let's say there is a building and you want to construct a new school over here. This building does not support school because you need multiple classrooms. So what do you do first? You destroy the site and make it a vacant land before you can start construction. That is cost of site preparation. Next, initial delivery and handling cost. He is delivering the asset to my house, all the delivery and handling cost. Installation and assembly cost. They will charge some money for installing the AC. Installing any asset, those installation charges will also be capitalized along with the cost of the asset. Cost of testing assets minus net proceeds. Let's say you tested an asset and you got some output. That output was sold and you got some small net proceeds. That cost of testing, how do I test an asset? Let's say you purchase the huge plant and equipment. To test this, you have to call an expert for testing if the asset works properly. During the testing stage, the asset has generated some output. That output revenue will be reduced and the net cost will be added to the cost of the asset. Lastly, any professional fees. Let's say you want to construct an asset here. You want to construct a building of 10 floors. You call an expert architect to see if the soil can hold a building of 10 floors. For that you pay some professional fees to the architect. Then that professional fees also will be capitalized along with the cost of the asset. So this is about purchase price and cost to bring the asset to its present condition and location. Last one is provision for cost of dismantling assets. What is this? Let's take a small example to understand. Let's say tomorrow Nokia wants to build a huge mobile plant in northeast India. The cost of this plant estimated is 10,000 crores. They want to build a huge plant for manufacturing smartphones in northeast India. They are estimating to operate somewhere between 20 to 30 years, and after that they will want to vacate the premises and shift to an other base. Now, many companies come to operate in a country in a specified location because benefits are given by the local government. After 15, 20, 30 years, if they feel it is not feasible, then they will vacate the premises. Now, if you are installing any plant or any asset with the intention of dismantling this in the future after 10, 20 or 30 years, to dismantle an entire plant of that size is not easy. You might have to spend another 10 to 20 crores just to dismantle the asset, close the operations and take everything back to a new place. Now, this cost will be incurred after 20 or 30 years. What the standard is saying, this future cost, find the present value of it today after discounting it and create a provision in your books today by capitalizing your asset for that cost, so that you will keep saving by charging a depreciation every year for the future dismantling by today itself. So this is the concept of provision for cost of dismantling asset. It's a much wider concept involving discounting, but this is an overview concept where I am going to incur some cost in the future of 10 or 20 years, find the present value of that cost today and capitalize the same. So this is about what cost will be included in my property, plant and equipment. Now let us discuss what are the exclusions. Standard has given some specific items which are specifically excluded from your cost of property, plant and equipment. Now let us see what are those items which the standard specifically excludes from capitalization, because most of this you do not get future economic benefits. Initial operating losses. Initial year of operations, if you have some losses, I cannot capitalize this. This is more of your revenue in nature. Cost of relocating part or all operations. I am doing business in one area. I am shifting to another location. So I will incur some cost for transporting all my assets from one place to another place. Now I am only relocating my operations. My revenue is going to remain the same whether I operate here or operate in a different place, and hence there is no substantial growth in future economic benefits. Hence this cost will not be capitalized. Cost of opening a new facility. Now, if cost of opening a new facility is going to create new economic benefits to you, you are going to get higher revenue because of this, then you can capitalize. But generally opening a new facility for marketing purposes then or increasing your production facilities, you will not capitalize the same. Cost of introducing a new product or service. This will be more of an R&D cost. We would have seen in AS26 also. All your research cost to introduce a new product will not be capitalized. cost of conducting business in a new location. Now, lot of companies will do marketing, they will go to new location, do business in new location to attract customers. All this cost is in the nature of advertisement and hence I cannot capitalize this. Admin or general overhead, administrative or general overhead expenses, you cannot capitalize this because there is no benefit for your company for generating future economic benefits. Now let us proceed to understand a few more concepts in AS 10. In the previous section, we had discussed about the definition of property, plant and equipment, inclusions and exclusions. Now let us see consideration. Whenever you buy an asset, you can pay consideration in monetary terms in cash or in kind non-monetary terms. Based on the nature of consideration, how do I record my asset? If it's a monetary consideration that is paid in cash, record your asset at the purchase price you have paid. We have seen exhaustively what is cost including, add all those inclusions and capitalize the same. However, if you are deferring the payment, delaying payment 6 months, 9 months, 1 year, if payment is delayed beyond a specific time, then you are liable to pay interest. Can I capitalize this interest also? Standard is saying check with AS 16. If this interest is incurred for a qualifying asset, then you can capitalize or else you cannot capitalize. Coming to non-monetary consideration, exchange of assets. I am giving an asset, receiving another asset. That time they are saying measure your property, plant and equipment at fair value plus or minus cash. Now, I will not record at fair value when the transaction lacks a commercial substance. Let's say it's a gift given for free because it's known person, then I will not use the concept of fair value because the transaction between the parties, the amount in which they enter will not be the exact market value. No. If the fair value of asset given up or received cannot be reliably measured, then I will not consider this formula of taking fair value. When let's say you're giving a car which was purchased 25 years back, a very old ambassador car. Today, very few people have an ambassador car and it is very difficult to measure the fair value. So when fair value of asset given up is not known, then try to measure at the fair value of asset you are receiving. If fair value of both asset given up and asset received is not known, then you have to resort to book value plus or minus cash. Take the book value plus or minus cash. This is about monetary and non-monetary consideration. Now let us look at few specific case transactions in property, plant and equipment. In the previous section, we had discussed about consideration. Now let us see a few concepts. Concept of self-constructed asset. Let's take a company like Tata, and if they want to construct a new factory building, they will want to purchase steel and cement for the construction. They have their own companies, Tata Steel and Tata Cement. Will Tata purchase these raw materials from outside market or within their group companies? They will obviously use assets from the group companies. Now, when you use self-constructed assets, my own assets, what I already have for construction, what price should I consider? Should I take the market price or should I take the cost price? The standard says whenever you self-construct an asset with your own output, then you have to measure it at cost. I will take the cost price of steel and cost price of cement. Another concept. You might have seen the Income Tax Act concept of slump sale. Let's say X Limited has sold its entire assets to Y Limited for a composite sum. For a lump sum, basically one full lump sum is given. Entire assets is sold for 1 crore. Now, How will Y Limited account all this in their books? They will apportion this 1 crore among various assets based on the fair value of these assets. I will take each asset, compute their fair value, and in the ratio, I will split this 1 crore when I account these assets in my books. Now let us proceed to few more concepts in AS10. In the previous section, we had discussed about a few concepts in AS10 relating to definition and various other concepts. Now let us see model of accounting for AS10. An enterprise can choose either cost model or revaluation model for presenting its property, plant and equipment. If it chooses a cost model, it will write its original cost less accumulated depreciation and accumulated impairment loss, if any, will be reduced, and the balance will be a net book value which will be shown in the balance sheet. In case of revaluation model, they will show fair value on the date of revaluation less accumulated depreciation after the revaluation is done. After doing revaluation, further depreciation, and if there is any further impairment loss, reduce this to find your net value. Now, option is left to the company. When I am initially recording an asset, I can choose cost model or revaluation model. But in the future, when you are doing subsequent revaluation, you will be asked to follow only revaluation model. Now, the question is, how do I group my assets? The standard says all assets which are similar in nature has to be grouped together. For example, plant and machinery is one grouping, land and building is one other grouping, vehicles is another group, furniture and fittings is another group, ships is another group. So you need to classify them separately, and for each class of asset you need to follow any of these methods for presentation. Now, coming to revaluation, how many times in a year or once in how many years can a company do revaluation? They are saying if the price of asset or if the fair value of the asset is very volatile, keeps changing consistently, then do revaluation every year. If the fair value of asset is not volatile, that is, price of asset is not volatile, it does not move much, then do revaluation testing once in 3 to 5 years. Now let us see how to account for revaluation. Accounting for revaluation is very simple. The standard says, if let's say the cost of asset is 100 and now it is increased to 120, upward revaluation, then such increase should be credited to the revaluation reserve or revaluation surplus account. Name is the same account, just different terms. Revaluation reserve or revaluation surplus account. If there is going to be a downward revaluation, let's say 100 has become 90, then the 10 deficit should be debited to the statement of profit and loss account. However, there is a small catch here. This is the case if the asset is going through a first time upward revaluation or a first time downward revaluation. Let us say there is an upward revaluation where earlier there was a downward revaluation. Let's say asset cost is 100. In year 3, I had reduced this 100 to 80 and debited my profit and loss account. Now 80 is again revalued in year 5 and it becomes 110. How to account for this increase of 30? The standard is saying increase up to earlier decrease, meaning earlier you had decreased by 20 which was debited to P&L. So up to the 20 can be credited to your profit and loss account, and over and above the original cost 10 will be credited to your revaluation reserve or revaluation surplus. So in summary, upward revaluation to the extent of earlier decrease, that difference 20 will be credited to P&L because earlier this 20 was debited to P&L. Over and above this goes to revaluation reserve. Similarly, coming to downward revaluation. Let's say before this downward revaluation, earlier asset was 100, which was increased to 110, and now this 110 is becoming 80. What the standard is saying is, earlier 10 rupees gain was credited to revaluation reserve or surplus. Therefore, now the downfall, first 10 up to 100, debit your revaluation reserve or revaluation surplus. Beyond this, the deficit, the 20, will go and debit to profit and loss account. So this is the concept of accounting for revaluation. Now let us proceed to next few miscellaneous concepts in AS 10. In the previous section, we had discussed about revaluation of an asset and how to account for the same. Now let us see two more small concepts. Concept number 1, retirement of an asset. What do you mean by retirement? I have heard people retire, but what do you mean by asset retirement? No. Most of us in our houses might have a cycle which we used during our childhood, but today we do not use it. It is still kept in the godown or in a corner where the asset is not used, but you have still not thrown it away, kept it in the corner. That is called retirement of an asset, meaning asset is no more in active use. What should be the book value of such asset? They are saying it should be the lower of carrying value, that is nothing but your book value. Let's say book value is 100. NRV, if I sell today, I will only get 30 rupees. Lower of this NRV 30. So you will record this at the lower of both. Here it is 30. This is the concept of retirement of an asset. What do you mean by derecognition? Basically, when will I pass the entry to asset account by crediting my asset account and removing the asset from my books of account? When will I do this? When you sell the asset on disposal. Disposal means removing the asset from your business. One case is sale of asset. Second is by donation. You don't need this, so you're giving it for free to somebody else. Remove the asset from your books. Third is entering into a finance lease. Me being the financer, giving the asset to somebody else. So I will derecognize the asset from my books and the other party will recognize the asset. Or whenever you feel no future economic benefits is expected, this asset will no more create any future economic benefits for me, then you will derecognize the asset. Remember, whenever an asset is retired or derecognized, if such asset has any balance in revaluation reserve or revaluation surplus, the minute the asset is retired or derecognized, if any balance is there in revaluation surplus account, transfer this to the credit of the profit and loss account. Now let us proceed to concept of depreciation and let us see what is there in the standard.